And joining me now is Kearabilwe Nonyana from Scope Prime Africa to give us his take on markets activity at noon. Kia, thanks so much for your time this afternoon. Just how concerned are you about the U.S. debt picture? I mean, that spending bill under the spotlight yet again, with a debate on the bill taking place yesterday. Now, the Congressional Budget Office estimates that Senate bill would increase the deficit by nearly 3.3 trillion rand. Trillion dollars, my bad. Are you concerned about this? Is this something you have your eye on?
Yeah, I think the deterioration in the U.S. fiscal position has been clearly seen, and for me, what is more concerning is the fact that they need to refinance a lot of their debt, which is coming up for maturity next year. And looking at where the U.S. treasuries are trading right now, I think it'll be unpalatable if they had to refinance at these rates.
Yeah.
And truly speaking, if you look at credit rating reports, they speak about a deteriorating U.S. fiscus. And if you look at the plans of Donald Trump, he's wanted to essentially cut taxes, increase tariffs, and keep on spending. And essentially, that is where the clash came with his good friend Elon Musk, because he does believe that at the end of the day, as much as the government wants to spend, he just believes that the U.S. fiscus is inefficient in spending the money that they raise.
And let's take a look, or rather reflect, on the 6 months that was when it comes to markets action. We are in the last day of trade for the first 6 months of the year, and we're seeing somewhat of a recovery taking place when we look at markets. The S&P 500, NASDAQ reaching record highs last week. European markets, when looking at a 6-month performance, doing really well. The JSE as well, pretty resilient. What have you made of trade over the last 6 months, considering that uncertainty really has proven to be the name of the game, but it doesn't seem to be really playing out when you look at that 6 months performance?
I think people are trying to find certainty in uncertain times, but what I've realized with what the market has done, especially in the latter part of this half, is essentially good news is good news, and the market gets buoyant, but bad news is kind of ignored. And to be perfectly honest, that's essentially what has happened. The markets are overlooking the geopolitical tension as well as the rhetoric which is coming out of the White House, and essentially it's a matter of credibility. They do not believe that Donald Trump is going to follow through with a lot of his threats in terms of tariffs. But what I could also say is that geopolitical tensions just seem to be popping out of nowhere. And that's the problem that the one we can't account for going into the second half, because of the fact that it seems like there are these Thucydidean traps that are happening with these rising powers and powers that have been so, that essentially bring this geopolitical risk, especially in the Middle East area. And to be perfectly honest, the market has overlooked that because I think they still believe that politicians will come to the table at the final hour because no one wants war.
And I was about to ask you about that, because it did seem like after the initial attacks in the Middle East between Israel and Iran about 2.5 weeks ago, markets did react to that, and they reacted downwards. The markets were in the red. But going into the next week, even though we did see attacks taking place, we did see the U.S. stepping into the conflict, it kind of seemed like markets were underestimating the direct impact. Even though we do have that ceasefire in place, there's still some tensions, going ahead within the Middle East region.
As I said, in political science, they coined a term called Thucydidean trap, and it speaks about these rising powers. And it was not the first time. I think one of our clients came to us in and about April, asking us, what do we really believe about that? And we had not priced it as risk in terms of our analyst team.
Yeah.
And they came to us in May as well, asking the same question. And it was the first time we really started paying attention to the tensions which were happening between Iran and Israel at the time. And I think right now there was a geopolitical risk premium which was put on oil and essentially taken out of risk assets. And you did see a structural shift. And I'll speak about this specifically to our market, because you started to see defensive sector rotation out of the recyclical resource stocks into defensive, such as the banks. But in the past week, it's essentially just happened. It essentially has seen the 2015 rise at really unprecedented rates, and you're starting to see that people are looking into defensive such as life insurance as well as banks. And I think even companies such as Anheuser-Busch have really been buoyed by this defensive sector rotation on our local market.
Interesting take there. I did notice that financials were doing quite well when those tensions were at their peak. Let's talk about some company news, some company updates out today. Exxaro warning of a decline in coal production and sales volumes and pointing to slower demand from Eskom. But they did say that this will probably not last long, and they are cautiously optimistic about their prospects. Just your take on those, or that update in particular.
Yeah, no, Exxaro is in a precarious position in terms of seeing that seaborne thermal coal as the Richards Bay coal terminal prices has been on the decline, and essentially that has led to such a mixed result. I mean, if you're seeing right across the board, seeing some declines in revenue as well as output, and that they do cite that Eskom's demand has really started to impact the results, and essentially this goes back to the fact that people have moved off the grid most of the time, because at the end of the day, what I always ask about Eskom's financials and the forecast of them is that they see an increase in top line growth, but essentially a decrease in output. And that just simply means that people are finding the electricity from somewhere, the energy from somewhere else. And essentially that has been a trend which has been seen since 2023. And essentially in the long term is still going to affect Exxaro, but it's those new acquisitions outside of coal that essentially is what the market was looking out for since the Sense announcement kept coming with that binding agreement that they are going to be purchasing some assets outside of coal in the near future.
All right, let's hit pause on the conversation and take a moment to touch on what your industry peers are finding interesting.
So stock pick for me is a US-based restaurant company. I'm feeling kind of hungry, so I'll talk about a food business. You may have heard of Chipotle in the US. So Kava is a fast casual restaurant business in the US. It's small. The cuisine that it serves is the Mediterranean cuisine. And the Mediterranean diet is the most recommended diet by dietitians. What's attractive about Kava is not only does it have a great product, its in-restaurant service model is similar to Chipotle's, the assembly line model. Its food is very tasty. I know of Americans who drive 20 minutes to a Kava when there's a Chipotle just 5 minutes away. So attraction in financial terms, it's got a long growth runway. At the moment, it only has about 370 odd restaurants. That's 10 times fewer than Chipotle has, and its goal is to get to 1,000 restaurants by 2032. So that's about a compound annual growth rate, about 15% over the next 7 years or so. So nice growth runway. On profitability, its restaurant level margins are between 23 and 25%, approaching Chipotle's level, so attractive economics. Revenue per restaurant as well as just 10% below that of Chipotle.
Serious real estate. Not because you spoke of it earlier. I was looking at GrowthPoint's results, where GrowthPoint is busy doing a lot of reorganizing, getting rid of suboptimal properties and trying to increase spend otherwise, in other places. And I was thinking, why now? I mean, if you guys should have seen this coming. And it made me thought of Sirius, which is an extraordinarily well-managed property company, mainly focused in Germany, where they continuously evaluate opportunities, upgrade in conjunction with whomever's occupying those buildings, which is mainly concentrated in the industrial space, upgrading them, selling them, looking for opportunity and disposal. It's an actively managed property company that's with an outstanding track record in, unfortunately, a very low growth area, which is Europe and Germany.
So Sirius Real Estate and Kava, are these counters you find interesting?
I think cover is an interesting pick, and I think what I like about it particularly is that it serves rural America, because when you see the geographical spots of where the restaurants are, they're more in the outlying areas and not in the more populous states. But what I also like about the management is that they really focus on margin integrity, meaning that they're continually expanding margin, and that compounded annual growth rate of trying to get to 1,000 stores is really what I see as value. But what I also think it's an alternative to true fast food that Americans are looking at, and essentially it's a healthier food, and it's a comparison to a company such as Kauai here, and I think there's been quite a lot of uptake from American consumers with Carver's kind of tasty food, as what they say. And in terms of Sirius, I mean, listening to where they operate in Germany and the UK, it's very low growth, but I think in the UK they've been particularly quite interesting that they've looked at non-core assets and non-core properties and started disposing of that, and essentially have got some free cash on their balance sheet to start buying up assets in Germany, especially in the industrial complex where NATO is seeing a lot of defense defense spending increasing, and a lot of companies which are going to benefit from the defense spend increase by NATO are in their industrial complex, and essentially they're making acquisitions around those areas, industrial parks there, essentially to prepare for that. So both of them are very interesting picks, but if I had to pick one of the two, I'd take Carver right now.
All right. And then what's your stock pick in addition to that?
So my stock pick is Excellent Corp. Is listed out of the US. It's a utility company. I mean, I was caught between the iShares utility ETF and really outright just making a stock pick in the area, and that's essentially looking at the energy demands from data centers in the US and how they predict and forecast that there won't be enough energy in the US to essentially facilitate some of these data centers, and looking at how operationally great Exelon is. It's a really good bellwether in terms of being in the utility space. But I think why I picked it is that in terms of the PE, in comparison to its competitors, which are fully priced, I think it is well priced at about $42 right now.
All right, let's leave it there. Thanks so much for your time and sharing those insights. That was Kearabilwe Nonyana from Scope Prime Africa.